Christin Tuxen covers the energy, metals and grain markets at Danske Markets. She is the bank's senior commodities analyst, joins me live now from Copenhagen. Great to see you. Thanks so much for speaking to us. So commodity prices seem to have recovered some of their losses. Is this the start of a sustained recovery or rebound?
Well, we think that crude oil prices are actually trading very close to their fundamentally justified value right now. Our estimates of fair value is around 110 for Brent oil, and then on top of that we would say that there is still the justification for a $5 risk premium due to the geopolitical situation in the Middle East. So I'd reckon that we will see a period of range trading between 110 and 120 for Brent over the next few weeks, months.
Do you see a scenario where it could possibly go above 120?
Yeah, we could see a scenario where we could come above 120 again, and that could be a scenario where we see the euro strengthen again. Should not forget that the ECB is due to hike rates within, a few months, in July we reckon. And that should give some tailwinds to commodities in general from a stronger euro. And then we still have fairly healthy growth across the globe. But also we have some signs of a softer period of activity coming up, which could give some headwinds to commodities on the other hand.
Now, can you take me through one of the key factors in your opinion, because it's interesting you say that crude is actually where it should be right now. It's trading at fair value. So what then was behind the plunge we saw in the past 24 hours?
Well, the plunge we've seen over the past week, I'd say, was very much due to the fact that the market was caught long commodities on a very large extent. And prior to the sell-off, when crude was trading, Brent, at least around $125 per barrel, we'd say that, well, 110 justified by fair value, then $10 a risk premium attached to geopolitics, and then we probably had $10 as well from a pure speculative component, and that component has been removed. And then over the past few days we've seen the market rebounding a bit due to the fact that markets realized that it was still justified to have a geopolitical risk premium on oil. So that is how we see the oil price composed at the moment.
And just picking up on that point about geopolitical risk, because we still have oil, Libyan oil essentially off the market. Saudi Arabia keeps switching its position on whether or not it'll make up for that. And even if it does, well, many analysts and experts saying the quality of the crude simply isn't the same. So is that going to become an increasingly important factor during the course of the year?
I think any OPEC response is going to be quite key for the oil markets. For now, we've seen OPEC being fairly reluctant to make up for the loss from Libya. And that means also that the June meeting for OPEC is going to be quite essential in steering market developments from here, because if OPEC decides to stay put and do not increase quotas, well, that doesn't mean necessarily that they won't increase production, because they might prefer to secretly slip more oil into the market, because that would keep prices likely higher than if they formally agreed on a higher quota. And that would then mean that they could maximize revenue, at least in their opinion, and they need that in order to finance some of the social initiatives they have taken lately. And then there's the quality differences between very light oil from Libya and then instead this being replaced by fairly heavy oil from Saudi Arabia. That is surely a problem for especially some of the southern European refineries, and means that we could see upward pressure on light heavy oil spreads in the crack market.
I just want to broaden things out a little bit, because, you know, such a debate going on right now between the bulls and the bears. Where do you stand on the outlook for the commodities market in general?
Well, in general, looking beyond the next few months, where I think soft patching growth is going to give some headwinds to commodities, well, looking into 2012 and even beyond that, I think there is a potential for a super cycle in commodities to still be intact. It was something there was a lot of talk about prior to the financial crisis, but I think the super cycle is being restarted. We know the story on the demand side, rising demand from Asia, emerging markets in general, and we have a lot of supply constraints in the oil market, in base metal markets and in grains markets alike. And these factors sort of add to a perfect storm for commodities, in our view at least. which means that we could see a commodities boom over the next 5 years, the next decade or so. So I would be a bull for the longer term.